Welcome back to RiskWire, where we break down the big trends shaping the housing market. My name is Reena Agrawal, and I'm a Senior Research Economist at Veros Real Estate Solutions. Let's talk about the 50-year mortgage today. In recent weeks, policymakers have floated this idea with the hope that more people will be able to purchase a home. So what's behind the buzz? Why are we talking about a 50-year mortgage? The short answer is affordability, or rather the lack of affordability. There has been a dramatic increase in home prices since 2020, but income levels have not kept up. Also, the cost of borrowing has gone up. Way back in 2020 and 2021, the mortgage rate was under 3%. Right now, the mortgage rate is around 6.3%. So there is a huge imbalance in the market today. There are many people that want to buy a house, but the financial doorway has gotten much narrower for home ownership. So policymakers are asking this question: if buying a home is out of reach at today's payment levels, is there a way to reduce those payment levels? And their suggestion is to stretch the loan out much longer. So on the surface, the math appears to be straightforward. You're paying back the same amount, but over a longer time period. But what would payments actually look like? So let's consider an example. Say someone wants to buy a home at $500,000. They have a down payment of 20%, and they get this loan for 6%. So if they take out a loan for a 30-year term, the monthly mortgage payment would be $2,400 per month. But if the loan period is 50 years, the monthly mortgage payment would be $2,105. So on the surface, it looks like a lifeline for borrowers who are stretched thin. But keep in mind, the interest on a 50-year loan would be higher than a 30-year loan, the same way the interest is higher on a 30-year loan in comparison to a 15-year loan. So why is that? The longer the term of the loan, the higher is the uncertainty. So lenders are going to charge for this uncertainty. So now these lower monthly payments can certainly help some borderline borrowers qualify for a loan. But there is a huge but here. There's a long-term hidden cost, a major cost. And that is these lower monthly payments come at a huge cost, because over the life of the loan, you're going to pay much more in interest. So going back to that same example we had, for the same $500,000 home, the interest payment over the 30 years would be $463,000. But if you take a mortgage for 50 years, the interest payments would be $863,000. That is almost double the amount. So with a higher interest rate for a 50-year-old loan, interest payments would actually be much higher. So you're saving some 12% or a couple of $100 a month when you go from a 30-year loan to a 50-year loan, but there's a big trade-off. And that trade-off is you're paying interest, which is like hundreds of thousands of dollars more. So this may not be worth it for many borrowers. Another thing to consider is equity. A longer-term mortgage means equity growth is much slower. So most of your early payments are going towards paying interest. And many folks, as you know, use equity from their homes to fund colleges for their kids or for other major expenditures. So someone who is in their 40s or 50s would have very low equity in their homes. Another consideration is, let's say you buy this house at the age of 35. So you are going to be making mortgage payments until you turn 85. And you probably won't be working in the last 15 years of this mortgage term. So here's the million-dollar question then. Would a 50-year mortgage make housing more affordable? The short answer is no. We're talking about shaving off 10 to 12% in monthly payments, while prices have gone up by 40 to 50% over the past 5 years. Another concern is that this type of a payment scheme may further push up prices, because if more people qualify for a mortgage, there will be higher demand for homes, and this is going to further push up prices. So such a tweak in financing may help borrowers at the margin, but this doesn't fix the core problem, which is that there is a scarcity of home. So the answer is construction of more homes that are starter homes, more homes that median income families can afford. So to sum it up, a 50-year mortgage means surely lower monthly payments, but it inflates the interest payments of the life of the home. There is slower equity growth, and this may also push up prices. Thank you for listening in. I'm Reena Agrawal, and please do subscribe to RiskWire.